Kia ora ana tātou katoa, tēnā koutou katoa, ko reira and ho, and welcome to the Reserve Bank of New Zealand, Te Pūtea Mātua. We are here for the very important process of talking to our monetary policy statement, our November statement. It is a wonderful, wise document. I really do hope that it provides wisdom and insight to everyone who is interested in why we have made the decisions we have made today. With me, I have Deputy Governor Christian Hawkesby and Chief Economist Paul Conway. We also have members of the Monetary Policy Committee with us in the front. I do want to provide an apology for Karen Silk, who is home battling a head cold. But hello, Karen, I know that you are watching. There will be an exam. So today, the Monetary Policy Committee agreed to maintain the official cash rate at 5.50%. We are confident that the interest rates are restricting spending in the economy and that consumer price inflation is declining. However, inflation remains too high, and the committee remains wary of ongoing inflation pressures from where we are. Internationally, economic growth has been stronger than was expected at the beginning of this year, but it does remain below trend and is likely to slow further. This subdued growth outlook will continue to restrain New Zealand's export revenues. In New Zealand, demand growth has eased, but by less than anticipated over the first half of 2023. And in part, this is due to the strong population growth. The OCR will need to stay at a restrictive level so that demand growth remains subdued and that inflation will return to the 1 to 3% target range. Wage growth has eased from recent peaks, and demand for labour is softening, with job advertisements now below the pre-COVID-19 level. At the same time, strong inward migration is increasing the population and adding to labour supply. While population growth has eased the supply constraints in the economy, the effect on aggregate demand are becoming apparent. This is increasing the risk of inflation remaining above target. As a committee, we are confident that the current level of the OCR is restricting demand. However, ongoing excess demand and inflationary pressures are of concern to us, in particular given the current elevated level of core inflation. If inflation pressures were to be stronger than anticipated, the OCR would likely need to increase from here. At the least, the Monetary Policy Committee agreed that interest rates will need to remain at a restrictive level for a sustained period of time, so that consumer price inflation returns to target and so as to support maximum sustainable employment. That's the end of my opening remarks. I do want to remind you that we're all here to talk about the monetary policy statement. So we're open to questions. Thank you.
Tom Palastraker from The Post. Have you had an opportunity to speak to the new government since the coalition was formed, and can you tell us anything about your interactions to date?
Yeah, so thank you. Yes, myself, in fact, the three who are on stage here met with the Minister of Finance and Prime Minister as part of our regular meetings. That was yesterday. We have the routine process of meeting in advance of the monetary policy statement to talk about the near-term outlook for the economy. Of course, the decision for the OCR hasn't been made by that stage, so we don't talk about the actual decision. The vibe in the room, incredibly constructive and highly focused on the job in hand. And the number one job in hand for us is to reduce inflation.
If you like, we can get the political questions out of the way. Did they ask you at all for advice on changing the remit? Because I know the government has expressed interest in that. I think legally they have to consult you first. Have they asked for that advice?
At this point, we have not been consulted on the remit change, but we're fully aware of the government's stated intention to move from a dual mandate to a single mandate. So, we will be consulted in due course. I will remind the audience as well that the bank did a very thorough remit review. This is a review of how the current mandate is operating, the committee structures, the horizon, so on and so forth. That is still very fresh. It's on our website. It was published towards the end of last year. Importantly, in that document, the Reserve Bank recommended primacy or more significance given to our inflation target.
Janae Tibshirani from the Herald. Did the new government suggest that it would do another review of the way the Reserve Bank conducted monetary policy through the COVID period?
Again, there were private conversations. We were talking about the economic outlook, but I will say again, we're aware that the government has stated publicly that they would be considering an additional independent review into the monetary policy decisions during the COVID period. So, we will wait to be, again, consulted.
So did the government detail what that might look like, or was that brought up in discussions yesterday?
No details, no.
All right, and I'm just turning to the document. I note that the Reserve Bank says that the pre-FU suggested that government investment might be larger than was previously signalled at the BFU. Could you just elaborate on that? Because I wasn't too aware of major increases in spending.
Yes, and thank you, and sorry to the rest of the audience on these complex acronyms. So the government at their half-year fiscal update provided numbers on expected government spending, consumption and investment, and then in their pre-election fiscal update they refreshed those numbers. In those numbers, total government spending continues to decline as a proportion of potential output, so the same path, but by less so than what they had said at the half-year economic update. And in large part that's due to the government investment profile being stronger as they got close to knowing what they needed to do post the weather challenges. So it's simply an adding to the government investment track. And a lot of it is in the second half of our projection period. It's not right here, right now.
So just to confirm that, so we had the pre-FU and it was, and your comments are in relation to the budget, a change from the budget?
Yes, so we in absolute terms, I mentioned that that government spending still declining proportion of potential GDP, but relative to the budget numbers, it is declining by less as a percent. And relative to our August statement, we only used the budget numbers in our August statement. Now we can use the refreshed pre-FU numbers. So and that's the difference. That's the difference in the spending.
Okay, so just what number are you looking at? Because the government consumption as a percentage of GDP didn't change from the budget to the pre-FU. So is there another? There another measure?
Total government spending, which includes consumption and investment.
Sorry, is that core crown expenses or what's the figure? Because core crown expenses only went up a tiny bit.
Like you won't find it in that document. We translate those numbers into the monetary policy space, and we get a number for government consumption and government investment going forward, and we express it as a share of potential output in the economy. I think is there a graph of that in the MPS?
There is.
There is a graph of that in the MPS.
Capital expenditure, and the graph is, sorry team, as we look through, nothing like putting people on the spot, but anyway, it's in there. 2.11.
Graph 2.11.
From Good Returns and Just the Business. Is that slower than expected decline in government spending behind the rise in the OCR track, or are there other factors as well?
Great question, thanks. And the answer is yes and yes. So one of the reasons that we have a higher profile is because we have more spending and investment, and that is in part the government relative to what we had anticipated from the budget. But the bigger driver of it is actually the total level of spending in the economy, and that is largely driven by the growth in the population. So we're in a really challenging period for monetary policy where per capita consumption is actually declining as a level, but overall consumer spending is rising because there are more people, more New Zealanders.
Oh, yeah, I did. Sorry, this is Lucy from Reuters. This was a real shock to the markets today. Nobody expected such a hawkish outlook. What did the market get wrong about your reaction function?
I would suggest that some people had anticipated it, it's not no one, but certainly in the pricing, the forward pricing for future monetary policy was that we would be at peak and likely be easing sometime next calendar year, second half. That was broadly where market pricing was. A lot of that is driven from not just domestic factors, but also internationally. The view that markets are saying we must be near the end of a tightening cycle globally. I want to be first to pick the next easing. And so you've seen this repeat behaviour of markets being updated by central banks and then over time trying to price in the next cut. We've been adamant. If you look, the only one who wasn't surprised are ourselves. We have been projecting for some time now to be holding at least the official cash rate at these levels through calendar next year. So, markets make markets, and we are providing our update into their decision making.
So the new projection of 5.69% implies another hike is more likely than not. Is that something you agree with?
No, I mean, we retain optionality throughout. We're showing an upward bias to the interest rate, but it's not a probability, yes or no. That is, the pricing of markets are saying we're not sure, is it 50-50, is it more than that or not? So you're reflecting, in part, market pricing. Why do we have an upward bias to our inflation projection? Because we need to balance the risks to meeting our remit. We spent a lot of time in our document and then a short time in our record of the meeting talking about some scenarios. And the risk to inflation in this country is still on balance more to the upside than the down relative to our outlook. Let me be clear, inflation is declining. Where we are nervous is it declining fast enough for us to succeed in the lowest cost fashion to the rest of the economy? So when we start from a very elevated level of consumer price inflation, we have limited headroom to absorb additional inflation surprises. We have a lot more headroom to absorb disinflation surprises from the starting point, and that's the reflection we're giving.
Hi, I'm Matthew from Bloomberg. Did you discuss raising interest rates today or at this meeting?
Yes, we did. Today was our final decision, but certainly in brewing up to our final decision, we had robust discussions around now versus later and whether it was going to be necessary or not. Where we landed is we are confident, we are restrictive with our monetary policy stance now, and that provides us the ability to wait, to watch the data, but certainly highlight our willingness to move if we have to. So, the watch, worry and wait has now got a willing sitting in there as well.
Okay, could I just ask, the new government has indicated that it wants to take advice on things like setting specific timeframes for you to achieve your policy goals and further reforms to the policy committee, and maybe even a return to a sole decision-maker model. What are your views on those proposals?
Yeah, thank you for asking, and these are all publicly known, a part of the tripartite agreement for our government. The first thing is, I can't comment on hypothetical decisions. We will have to deal with whatever mandate we've got. So, importantly, to say today's decision is made with a committee, with a dual mandate, as per purpose on this side. Our views on the other issues are covered off very well, very timely in the remit review that I mentioned. That remit review suggested on balance to give primacy or higher prominence to our inflation goal. We can never ignore the impacts on the real economy, the labour market and so on, but primacy, so that's our considered view there. We also talk about the challenges around defining a date or a medium-term target, and our view is, and as again discussed here, the lags remain more or less the same between what we do in inflation Nothing's particularly changed there. It's the nature of the shocks that will always hit the economy that we have no influence over. So, we find it economically extremely difficult. I'm not sure how you would do it, actually, to give you a date and a time by exactly when you'd be at the midpoint, because what we know today is where the economy is. We broadly know how it works and hence what we need to do with the interest rates to achieve our inflation mandate. But what we don't know is what is going to be the next unanticipated event. And that is why that medium-term type view dominates globally. Can I just put the last mention to the committee, given they're here? My personal experience of operating with a committee is excellent. The level of scrutiny and discipline by being with a committee, the challenge of writing a record of the meeting that the committee members are with has truly added to the richness and insight to the decision making.
Thank you. Just one final one. This government obviously has quite a different view to the previous one on how Maori language and culture should be used in state institutions. Firstly, do you think that change will result in any changes at the Reserve Bank, any tangible changes? And secondly, as someone who's clearly embraced Maori culture and language and put it at the centre of the bank's identity, how do you feel about those changes that the government's bringing in?
I won't go into my personal experiences because I'm here representing the bank and talking about the monetary policy statement. And professionally, the bank is very proud of its name, Te Pūtea Mātua, and it will continue to use that, in addition to the Reserve Bank of New Zealand. Our embracing of Te Ao Māori has been more about how we work together as opposed to what our mandate is, and all of our actions and activities are firmly anchored to our legal mandate. So I feel in a very strong and proud position to be standing here.
Thank you.
Hi, it's Dan Brunskill from Interest. A few questions. First of all, when migration first picked up, there was a bit of talk about how rather than being inflationary, it was actually easing pressure in the labour market. It seems like your view on that is developing and you're sort of definitely of the view that it's an inflationary risk now. Could you talk a little more about how you're seeing migration affect the economy?
Yeah, I'll pass it over to Paul.
Sure,
Yeah.
thanks, Dan. So developing is the right word in terms of our view with respect to migration. Initially, we saw migration, clearly easing the labour market, which was very helpful, taking some of the heat out of that. We said that the demand side effects were likely to turn up at some stage, and what's happened over the last 3 months since the August statement is that we are seeing more evidence of strong population growth having an impact on demand in the economy. So most obviously, there's a bit of action in rents, housing rents, which has been associated with strong population growth, but also looking at things like spending and consumption. Again, there's an interesting chart in the document which shows total consumption in aggregate, which is kind of flat, as opposed to consumption per capita, which is clearly showing a decline, and obviously the difference there being migration growth. We're always studying these types of effects, so our view does evolve, but it certainly hasn't changed between statements. There's just more of an emphasis on those demand side effects because they've become more apparent.
And it's our challenge right from the beginning is that any particular level of population growth, its net impact on inflation is going to depend on the context of where the economy was at the starting point, above, below capacity, excess or shortages of labour. And likewise, the nature of the skills and the people who are turning up. That's why it always evolves. So the absolute certainty is demand will increase because there's more people, and we are seeing that globally. Those countries who are experiencing high net inward migration, high population growth are experiencing higher inflation, largely due to the rental components sitting in those consumer price indices. We are one of those countries. So supply has been positive, likewise demand is positive, net, it's working its way through the economy.
And can I just add to that, Governor? So migration has been stronger than we anticipated, so it peaked at a little over 100,000 in annual terms. We've got it coming off over the projection horizon to somewhere around the 36 to 40,000 annual working age population net inflows, which is about what it was in the few years prior to COVID, which is still reasonably strong relative to the rest of our history.
And it's an assumption. We can control who comes in, we can't control who leaves or returning Kiwis.
Cool, thank you. My other question was around this idea of timelines on inflation. You said that it's very hard to set one, but it does seem a little bit like you have informally set sort of September 2024 as being when you want inflation back in the target, and in the summary of meeting you said among the committee there was sort of not much tolerance for letting it go on any longer. Are you thinking of that in your head as being a deadline, and if you have to raise rates higher to get there, you'll get there, but you're not willing to let it go past that quarter? Or
So no, it's not a deadline. It's our best estimate, and it's an estimate around where we feel most comfortable right here, right now. Why is it not a deadline? Because monetary policy takes 18 months to 2 years to work through. So whatever we do today is still going to be, in a quarter's time, it's going to be 2 years from then. We can't. Where we are nervous is that inflation has been outside the band a long time, whilst headline inflation is coming down, core inflation is coming down, but by not as much, and it remains persistent. This is a global phenomenon. Added to that, inflation expectations are coming down with actual inflation, but the 2-year inflation expectation is moving pretty slowly. It's not rushing back to the midpoint of our target range, which would mean we're on top of it. And likewise, if you probably need to get quite close up to the document, but you'll see that the 10-year inflation expectation is creeping up away from that midpoint of the target band. We take that as a personal assault on our credibility and mandate here at the central bank, because future inflation should be at the midpoint of our 1 to 3%.
So a rate hike, a rate hike you deliver sometime in the future is combating an inflation risk very far out in the future, well beyond September.
We're trying to sniff and smell and assess the inflation risks, but by the time, if we had to react and lift rates again, it's still going to be the same transmission mechanism. We can't unnaturally speed that up. If we did, we'd probably have to do many more than one rate hike. That's the nature of monetary policy. It's like playing with the thermostat in this room.
Thank you.
The Federal Reserve yesterday flagged the possibility of cutting rates in a few months. If that happens, would it change the outlook for New Zealand policy, and would you still hike if the US was easing?
I'm not aware of the Federal Reserve statement. There are many spokespeople for the Federal Reserve. When they come out and speak officially, they remain as equally concerned and cautious about future inflation. The market's very excited. There are many spokespeople for the Federal Reserve. They have the 14 governors. They all speak. So really what you're talking about is the market wanting to hear something about cutting and jumping on that more than they want to hear about holding or even future rate rises. So, we'll wait to see what the official Federal Reserve decisions are. On top of that, of course, global interest rates matter for us, whether it's via the exchange rate because of the interest rate differential, or whether it's because they're reacting to something that will ultimately affect us. So we are very cognizant and highly tuned into global developments.
And you mentioned that house prices are going up maybe faster than you expected. Do you think it's immigration that's driving that? If it's not immigration, what is driving it? And how fast can we expect to see house prices go up in the near term?
Do you want to talk about the offsetting forces, Paul?
So, as I mentioned earlier, we're seeing the impacts of fast population growth on rents. It is possible that fast population growth is also putting upward pressure on the house prices. I should say, house prices are about 2.4% off their trough after a 15% fall. So, it's fallen more than it's gone up. I think migration possibly has something to do with that. Of course, the other thing going on there is nominal income growth is a bit higher, and those factors are sort of, high interest rates are working in the other direction. So yeah, on balance, we are seeing a bit of life in the housing market. As far as our projection goes, we're still expecting house price growth to be relatively subdued over the projection horizon.
Giles Beckford from Radio New Zealand. Just following on from that comment about house prices, how prepared are you for debt-to-income ratios, and is there a prospect if the market takes off, they will be imposed next year?
Yes, so we are getting in a heightened state of preparedness for those, and we'll be talking to the market. The good news is I've got Deputy Governor Christian Hawkesby there in his heightened state. Christian?
So we've asked the banks to be operationally ready for debt-to-income ratios sort of March, April next year, and so that's a process they're going through at the moment. There's a lot of background to that, and then we'll make a decision early next year about what we do with debt-to-income restrictions and loan-to-value restrictions as well. So there are two key tools in our financial stability toolkit.
You don't need to refer those to the government for imposition on DTIs? You've got the authority to just do it?
That's right. That's within our current memorandum of understanding about the delegations that are there.
Adrian, can I just follow up? In the past MPSs, you've always had a message for borrowers and households who have been squeezed, with people now looking at the prospect of no rate cuts likely before mid to late 25 by your projections. What's your message to them?
It remains the same. First and foremost, our projections are very little change from even 15, 18 months ago. We talked about the official cash rate being at this level and for some time to come. So, that message has been loud and clear to people. And I think it's been heeded. You are seeing credit growth slowing rapidly, both in business and mortgage lending. In fact, banks, they've been challenged to keep the lending statistics going. Likewise, we have yet to see the full feed-through of what we've already done to interest rates into actual households. While the mortgage rates have gone up, people are still rolling over. We're still only 2/3 of the way through that rollover in the mortgage book. We estimate that on average, from 15% of current disposable income, that will rise to around 20%, 19-20% of disposable income between now and its peak in mid-next year. So there's still more on the pipeline. Advice to them, and that is to stay close to the bank and to read the monetary policy statements, stay cognizant of why we are doing this and the types of risks we see out there.
Could I please put in a plug for the monetary policy snapshots as well? If people are looking for a very easily approachable rendition of the key messages in the MPS, I recommend the monetary policy snapshots to you.
Janae Tibshirani from the Herald again. I'd just like to pick up on the government spending questions that I asked at the beginning. I note that in the budget, the capital expenditure increased by a lot, and a lot more than was flagged in the budget policy statement, or whatever that's called previously. And same with operational expenditure. I wasn't aware of expenditure increasing in the pre-FU. So I just wonder why that the government spending has been outlined as a factor in this document, but wasn't seen to be a big issue after the budget.
We could follow up with the actual statistics. The simple thing I will say is that we operate directly off what we receive from the government, the half-year budget, the budget and then the pre-FU, and the difference there. It could well be the differences in translation from, dare I say it, generally agreed principles and practices of accounting through to the translation into SNA accounting for monetary policy and economic purposes. Please don't ask me to explain beyond that.
Right,
Ask Rebecca.
Okay. Fair enough. Okay, thank you. And then just for the committee, did the committee, in its decision-making, today, factor in Westpac cutting some of its longer-term mortgage rates?
No, we have, effective mortgage interest rates that we see in the document. We're not real-time following how banks are behaving, competing or whatever, so that's not the case. One of the big issues, and I'll get, because Christian's warmed up now, to chat about really has been, where the banks' funding for their mortgages are coming from relative to the official cash rate forecast.
And something that we call out in the document is what we're seeing in term deposits, and they're a key element of funding for banks, and term deposits do tend to lag the official cash rate moves, and we think there are more rises in term deposits on the way that will keep upward pressure on mortgage rates as well. That's part of our core assumptions.
And also the global swap rates, as international interest rates expectations declined, even though the margin for New Zealand stayed the same, that declined on that level. And so some of the funding banks have been able to pick up are lower in price than the official cash rate, but that is working its way through the system. So, judging from market reactions so far, swap rates have moved north. The cost of bank funding has just gone north.
Right. So to what extent are you, through this statement, trying to lean against the market, which push back against banks potentially cutting mortgage rates, even if they're those sort of less attractive?
I would say to an incredible degree. We have an incredible influence over the level of borrowing rates in the New Zealand monetary circle, and we are saying that they need to be at this height for a long time to come. It's if banks want to take risk and bet against it otherwise or not, that's their competitive desire. We know what we're doing.
Hi, Dan from Interest again. One question. This is the last meeting until February. There's sort of a 13-week gap. In monetary policy terms, quite a long time. Do you think it's appropriate to take such a long gap between meetings at a time when inflation is above target and the economy arguably is at a turning point? Have you given any thought to rearranging the schedule of meetings so there isn't such a long gap?
Yeah, great question. And, rust never sleeps, inflation never sleeps, and nor does the Monetary Policy Committee. So we will be receiving real-time data. We'll be getting information updates as the public comes, policy decisions from new governments, etc. If there's something there that necessitates additional conversations, we aren't bound by those calendar dates. They are known dates, but as you're all aware, we have moved outside of those. During the initial COVID period, we couldn't see enough of you there for a few weeks. To the best of our knowledge, we're not anticipating any of those shocks, so we're comfortable waiting to February. But it doesn't mean we're just going to shut the door and close our eyes.
And then final question from me would be, the market is looking for rate cuts. Everyone's asking that question constantly. Would you be able to provide any guidance as to what you are looking for before you do rate cuts? Is there a trigger, some sort of economic conditions that you need to see before you even think about it, separate to the track?
It's going to come down to confidence. The confidence the committee can get collectively that inflation is without doubt returning to its midpoint over the period we have influence, that period being that 1 to 2 year ahead. What may give us that confidence? Inflation expectations coming off quickly and being well anchored to the pace of where it is. Policy decisions that may mean less than otherwise government spending pressure, lower than otherwise considered global economic growth. We're looking for a package of things that says demand growth in this economy is going to be slow enough to enable the inflation pressures to come out. We're very pleased with how it's been tracking so far, but we have talked about that asymmetry of risk of where we sit.
Thank you.
Wonderful. Janae, sorry.
Yep, sorry again. I appreciate it's still early days in terms of the formation of the new government, but from what you already know in terms of the policies that will be introduced, how inflationary or not do you think they'll be?
Yes, we can't talk about hypotheticals, about what possible future actual government policies will be. We never have done. We always wait for them to be official And we wait for the Treasury to provide their best first, what they think are going to be the large drivers on government spending and government revenue. There are so many unknowns out there. There are some spending offers, there are some revenue offers, there's some. It's just too early to be able to say, or whichever, how or what we may need to react to.
I mean, could we look at the property market specifically and the interest limitation rule being phased out more quickly than it previously signalled, and the Bright Line test going back to 2 years? I mean, these things might put some stimulate the market. Are those sorts of policies ones that you might be watching?
Yes, absolutely. What happens to the construction sector? It's a significant part of any economy. It's a significant part of ours, and at the moment it is slowing. And our projection, given that pipeline of new build coming off quickly, we see quite a considerable slowing in residential construction activity, and in fact we're quite concerned about the commercial construction sector. So what happens to that level of aggregate activity? Likewise, what might happen to the price of houses and rental costs? These are all important parts. But we have to remember there's going to be a supply side component and a demand side component. And until we have the type of information we need, to understand what, to assess the types of implications, that's a concern. We've put the flag up here that, it's domestic inflation that's causing the challenge. And a big component of that is dwelling cost. That is a very expensive part, as it is in Australia, as it is in Canada, as it is in these places that have experienced a significant influx. And it's happening at a time of a slowdown in residential construction. Wonderful. I'd like to thank everyone very much. Again, our Monetary Policy Committee members, I stand here on the shoulders of giants. Thank you very, very much. And have a good Christmas and keep those jets cooled, I think, is the answer. Kia ora.